International Conference on Accounting and Finance.
Hello everyone, I'm very sorry that we took some time setting this up. A very good morning, ladies and gentlemen. My name is Anomitra Banerjee, and this is my friend Nitish. We both will be presenting. We will be talking to you about our research and analysis of the U.A.E. banking sector. The question which might arise in every one of your mind right now is why suddenly analyze the U.A.E. banking sector? The answer is quite simple. Back in 2013, when His Highness Sheikh Mohammed bin Rashid Al Maktoum, the Vice President of U.A.E. and the ruler of U.A.E, announced his plans of making U.A.E. the global capital of the Islamic economy, we as a team thought to analyze and check how ready U.A.E. was to render this responsibility. This became the main aim of our paper. As we all know that the banking sector is the core of any economy, we decided to check the efficiency and stability of different banks in U.A.E. to understand how efficient they were, how stable they were, and most importantly, how ready they were to hold $2 trillion, I repeat, $2 trillion worth of capital.
U.A.E. is a federation of 7 emirates, namely Abu Dhabi, Ajman, Dubai, Sharjah, Al Quwain, Ras Al Khaimah, and Fujairah. The U.A.E. is traditionally an oil and gas exporting nation, and it's also one of the main members of the Gulf Cooperation Council. This country has 52 banks, of which 24 are nationalized and rest are foreign banks. With accumulated assets equating to 142% of the GDP, the U.A.E.'s banking sector is considered to be the second largest in the region after Bahrain. This promoted excess credit growth, inflation, and every financial system, every economy has some flaws, and so did U.A.E. The rich-looking, abundantly wealthy U.A.E. was brought down to its knees during the financial crisis of 2009. The crisis exposed vulnerabilities within the financial system and affected U.A.E.'s trade and financial sectors. Also, the fall in oil prices had a significant impact on the government finances.
The international phenomenon of globalization had to be accepted by the U.A.E. government. For long, they had kept themselves closed. They kept themselves closed behind walls, but deep inside, I think that they knew with changing times, they too had to change. With the launch of the Dubai International Financial Center, U.A.E. marked the beginning of a new financial hub in the Middle East. GIFC is a financial free zone, and it was seen as the first step towards the liberalization of the economy. Foreign banks now enjoy full autonomy with no capital repatriation. This lured many foreign banks to set up their units in U.A.E. Some notable names are Barclays Group, Citigroup, and Hughes Group, who came to U.A.E. in late 2006.
I still remember, for days we sat down formulating the research methodology. Anomitra, do you remember how many cups of coffee we had?
So many, I still don't remember the actual number.
Well, the research methodology is an analytical and cross-sectional study of analyzing and comparing the micro and macro characteristics of different banks in U.A.E. The scope of the study involved 12 banks, of which 4 were Islamic and the rest were conventional. We did a review of 6 years, spanning from 2006 to 2012, and dividing them into 3 periods, basically before crisis, during crisis, and after crisis. And also to analyze the bank-specific characteristics, we made use of data obtained from the credit charts of banks' annual financial reports.
To measure the financial soundness of the Islamic banking sector, we employed the use of financial ratios, mainly because it was not done in U.A.E., pertaining mainly to U.A.E. before. We used ROA, that was return on assets, CIR, cost-income ratio, capital asset ratio, CR, LDR, loan deposit ratio, and ROA, return on equity. These are the 5 parameters which can actually tell us how efficiently and how stably a bank is working and contributing towards the economy.
ROA, the return on assets, is a measure of how efficiently a bank is utilizing its assets. It is evident from the graph that the Islamic banks perform better than their conventional counterparts. However, both the banks fell significantly before stabilizing in 2011. The conventional banks fell from 2.9% to 2.1% before stabilizing at 2.7% post-crisis. The Islamic banks, on the other hand, fell from 4.7% to 4.2%, further declining to 3.1% before stabilizing. The difference, however, is that the Islamic banks fell over a period of 4 years, whereas the conventional banks fell immediately in response to crisis. This slow fall in response to crisis by the Islamic banks helped U.A.E. to pump less money into the banking sector and concentrate on the other sectors of the economy as well. It also provided time for the country to analyze and change its policies before further economic decline happened. The CIR, the cost-income ratio, is a key financial indicator in evaluating banks. It shows investors how efficient a bank is being run. The lower the CIR, the more profitable the bank will be. As it is evident from the graph that the conventional banks have significant fluctuations in the CIR in comparison to the Islamic banks, which have been relatively stable during the period. These fluctuations indicate significant problems. As the CIR rises from one period to another, it means that the costs are rising at a much higher rate than income. The conventional banks, as you can see here, have significant fluctuations during the crisis time, which indicates that they were hit hard and were struggling to meet their operating costs with their reduced income.
Capital asset ratio is a measure of the bank's capital against its risk-weighted assets. A robust capital position means that the bank has a lot of buffer which they can use during unforeseen losses which might arise during crisis. As evident from the graph, we can very well see that the capital asset ratio for Islamic banks is stable, which means that they have a very high asset quality. A high capital asset ratio means there is less money left for investment and growth. But a low capital asset ratio means that there is less money which can be used as buffer for unforeseen losses. So it is always advisable that every bank keeps an optimum index. In our study, we found that the capital asset ratio of Islamic banks were at 15%, which is an optimum index given the fact that the Bank for International Settlements have kept the index for CAR at 8%.
The LDR, the loan deposit ratio, is the statistical measure of banks' liquidity. As it is evident from the graph that the Islamic banks have a lower LDR in comparison to conventional banks. The high LDR of conventional banks indicates that they have less liquidity to meet any unforeseen circumstance, because of which they were hit hard during the crisis. The Islamic banks, on the other hand, have a lower LDR, which means they have more liquidity to meet any unforeseen circumstance. And also, the lower LDR means that the banks might not be performing as much as they could be. They might not be earning as much as they could be. Coming to ROE. ROE is one of the most important profitability metrics. It shows how much a company makes in comparison to its shareholders' equity found on its balance sheet. It is one of the most important performance measurement tool. Overall, ROE of Islamic banks is seen to be higher than that of conventional banks, which means that they are in a much better position and will be able to generate money more easily for their future growth.
The global financial crisis had a severe impact on the whole of the world, and U.A.E. was no exception. Several financial institutions were closed down. Many profitable institutions lost their profitability. Several companies merged together to remain operational. In the banking sector of U.A.E. although we found that Islamic banks performed much better than their conventional counterparts. They were found to be more stable, secure, and have higher liquidity. But ladies and gentlemen, as an economy, U.A.E. performed much better than any other Middle Eastern countries. U.A.E. is no longer an oil exporting nation, but it has diversified its economy into trade, tourism, and construction. We as a nation have already proved to the world how strong we are. We built a city from the scratch and made it the most beautiful one on this planet in a decade. Every year we make new world records and break the older ones. But it is time the world understands this and renders us responsible. We as a team have found that U.A.E is ready to be a hub for global finance. That U.A.E is ready to realize the dream of His Highness Sheikh Mohammed bin Rashid Al Maktoum. But it is time, ladies and gentlemen, that the world and entire humanity realizes this fact. So I ask you today, is U.A.E ready to be a hub for global finance? What do you say?
Thank you.